Hello, everyone. Welcome to today's Marshall webinar, the GameStop short squeeze and its risks to our economy. Towards the end of our discussion, we will hold a Q&A session. Please feel free to submit your questions at any time during this webinar using the Q&A feature at the bottom of your Zoom window. Please also note that this session is being recorded and we will send a follow-up email to all of our registrants. Now, acting as both our moderator and panelist for today's discussion, we have Professor Larry Harris, who holds the Fred V. Keenan Chair in Finance here at USC Marshall. As a former SEC chief economist, his research, teaching, and consulting address regulatory and practitioner issues in trading and investment management. And he is also the author of Trading and Exchanges, Market Microstructure for Practitioners. Larry, the floor is yours.
Well, thank you very much. Before we start, let me bring to your attention that we're at the beginning of Black History Month, and the USC Marshall School has put together an excellent program. You can find that program by just searching on USC Marshall Black History, and I strongly recommend it to you. It's my great pleasure to introduce to you a truly excellent panel of experts to talk today about the GameStop issues. First, we have Terry Odine. He's the Rudd Family Foundation Professor of Finance at at the Haas School of Business at the University of California, Berkeley. He's an expert in how retail investors behave, and particularly in relation to their brokerage accounts. Pete Kyle is the Charles E. Smith Chair, Professor of Finance at the University of Maryland, Robert H. Smith School of Business. Pete is a very broad-thinking economist who spent a lot of time thinking about manipulations of various types. We have with us also Paul Brody. He's Chief Financial Officer, Treasurer, Secretary, and a Director of Interactive Brokers, as am I. Paul knows a tremendous amount about the challenges of funding a brokerage, its capital requirements, and how clearinghouses operate, and the risks that clearinghouses face when dealing with brokers and in extraordinary situations, such as we see with GameStop. And then finally, we have Fei Li, who's a partner, head of equities for Research Affiliates. They are a advisor to buy-side investment managers. She knows a tremendous amount about how the buy side relates to the markets and how they think about events such as the type of event that we're just going through here. So I'm going to start out by just laying out the framework for what's happening, just so that we're all on the same page. You're all quite aware that there's been phenomenal volatility in GameStop during the last week in an event that's called the short squeeze. Just so that we're all on the same page, let me talk about what it means to sell a stock short and what the dangers are. And I will identify some of the people who got hurt and some of the people who benefited from this recent volatility. And then we'll turn it over to our experts to talk about the event from their unique perspectives. So first of all, what is short selling? If you think that a stock is overvalued and likely to drop in value in the future, and you own that stock, you would sell the shares that you own because you'd avoid losses if you did that. If you didn't hold those shares, if you didn't own shares, you could still profit from your knowledge. Again, it maybe not knowledge, but your prediction, by selling the stock short, which means that you borrow stock from somebody who owns it, and then you sell it, and there'll be somebody who will buy it. The reason you need to borrow the stock is because the person who is buying the stock is expecting to receive it. And so your broker on your behalf will arrange something called a stock loan, and you'll pay a little bit of interest, sometimes a lot of interest if it's hard to acquire the shares. You'll pay some interest to the broker, who will pay it to the lender so that you can get those shares. And now you'll profit if price subsequently drops. So if price does drop as you were predicting, you will be able to buy it back at a cheaper price. And when you buy back those shares, you then deliver them back to the lender, and the lender is out of the story, and you've made money because you sold at a high price and bought low. Now, normally you make money by buying low and selling high, but you can also make money by selling high and buying low. And that's what short selling is. Now, I told you the good story from the point of view of the short seller. If prices fall, the short seller makes money. The most money that a short seller can make is 100%. That's if they sell, say, at $17 and price goes to zero. But prices can also go the other direction. So if the short seller sells and prices subsequently rise, as they did with the GameStop story, prices rose all the way up to 480 something, huge increase. Here's what happens. The short seller is losing money because as prices rise, they bet that prices would drop, but if they have to repurchase the shares, they will have to repurchase them at a higher price. And then they will have violated the formula for making money. They would have sold low and bought high, and that's how you lose money. Now, it's a little bit more complicated, this, but I'll share with you one other important detail, and Paul will probably discuss this further as well. The lender of the stock is always concerned about whether they will be able to get the stock back. That's true for any lender. They always want whatever they lent back, and that's fair. So we secure those loans with a system that says that when you borrow the stock, you have to give the lender the money that you received when you sold it. And now here's where it gets interesting. If price subsequently rises, what we ask is for the short seller to give money to the lender to compensate for the fact that the price has risen. So if price goes from $17 to $20, then the lender will have to, the short seller will have to give the lender, through the intermediation of the broker, the short seller will have to give the lender $3 per share. And so you can see that if price goes up to $480, an awful lot of money has to move as the short sellers are losing money. If the short seller doesn't have the money, they get caught in a difficult position. They will have to buy back their shares because they cannot continue to keep the position open. So when the shares are purchased back, the purchase volume tends to, these buy orders tend to push prices higher, and the short seller locks in losses that can be very, very damaging, as we've seen in this last episode. Now, a short squeeze is what happens when a number of people recognize, or just by chance prices rise. When people recognize that there's a potential for squeezing the shorts by pushing the price up, that's what a short squeeze is. So people acting either in concert by design or perhaps coincidentally pushing prices up because they recognize that there's a vulnerability in the system. When the prices rise, then the shorts will be caught in what's called a short squeeze. And I mentioned that it can be by design, or they can also end up getting squeezed simply if the company announces that they have fantastic earnings and the price shoots up or something like that. That could also cause a short squeeze. That's certainly not what happened in the GameStop story. So I've explained to you how the shorts lose money. Let me explain to you another player that lost a lot of money in this event, and then we'll move on to our panelists. So the shorts lose money because price went up when they weren't expecting it. And if it was forced up on them by traders who were designing to do this, who understood that this is what would happen, then of course there's potential legal issues and ethical issues and public policy issues that we'll be discussing. But now let's talk about what happens when the price is really high. So price goes high, and there are a lot of individual investors, and I imagine that Terry may talk about this, who see that prices have been rising, and they know that their neighbors have made a lot of money, and they think, well, maybe I can make some money too. And so they end up buying, and their buying tends to push prices higher. But at some point, you know that this can't go on forever. And so there's undoubtedly going to be a lot of traders who buy at high prices, um, quite foolishly, probably, but maybe they don't know any better. And then when the event ends, as it certainly must, and prices fall, those people last holding the bag end up losing. So the situations like this are something like a Ponzi scheme that requires new people to come in and buy when other people are selling. And so the organizers of, if there were organizers, or the coincidental beneficiaries of this short squeeze, when they're selling out at higher prices, if other people are replacing them, then prices won't drop. But if prices drop before they can sell out, then they won't have made as much money as they might otherwise would. So we have concerns about uninformed, maybe foolish traders who have bought at very high prices and end up holding the bag at the end. So they may have bought at 400 and prices drop to under 100. That's certainly something that will be of great concern to them, but it also may be of concern to us. So I'm going to close now with just a few comments about why we might be concerned about why people lose money. So the people who bought at high prices, who are uninformed, well, it was their decision to buy, but we have a public interest in the fact that they're losing money, because many of them will look at the markets in the future and say, gee, I just don't want to do this kind of trading in the future. In fact, maybe I don't want to do any equity trading at all. And so they won't invest in the markets, and their capital then can't be used by companies to build new projects that benefit all of us. And then perhaps worse, if they're not invested in the markets, they won't be saving as efficiently and as successfully as many other people, and they'll end up retiring less wealthy than they otherwise would. And if there are a lot of them, they may vote to have the government subsidize them in their retirement by raising retirement benefits, and the rest of us will have to pay for that. So you may not have a lot of sympathy for people foolishly engaging in this behavior, but it will have consequences for all of us. I leave it to others to judge how serious you think they are. But I can tell you that my students, many of whom who bought, and almost all of whom have lost, say that they're really reluctant to get back in. And this is at a time when young people are in their formative ages, and lessons learned now can be long-lasting lessons. Now, what about the short sellers? On average, short sellers do tend to be right. There have been many studies that have shown that short sellers, when they start selling, they push prices down. Nobody likes that the prices are dropping, certainly not the companies who are being hit by the short sellers. But the prices tend to reflect the fact that the companies are overvalued, and the prices do tend to stay down. That actually provides a very important service in the economy, though nobody likes the messenger. The service is that it ensures that prices reflect values, so that our uninformed traders don't end up buying at inflated prices and then losing when prices subsequently drop, as they surely will if the company is suffering serious problems. But it also ensures that companies that have inflated values are not able to issue new shares at inflated prices. Because when they issue new shares at inflated prices, they consume capital that might otherwise be used by other companies with better ideas. So, for instance, now companies that have better ideas might be investing in vaccine research or new material research that will facilitate the production of new airplanes or rockets to the moon, or who knows what, or simply new services. But the key thing, and the reason why our economy is so wealthy, is that we've used the markets well to allocate capital to people who have the best ideas. Now, this is not just idle discussion. Let me close with one final observation. AMC was also targeted by the Reddit Wall Street, what's it called? Wall Street Bets group, or people affiliated with it or identifying with it. And the price of AMC went up a lot. Now, AMC is a business that also has problems, as does GameStop. AMC's problem is twofold. People have discovered that if you put a 65-inch monitor on your wall and have 4K resolution, that you get quite an incredible experience, and that you can stream movies on demand to your house. And even more so with COVID, they've discovered that they maybe don't need those theaters as much as they did. And of course, COVID by itself is keeping people out of the theaters. So the company's in a lot of trouble. Even if it weren't for COVID, it wouldn't have the same prospects that people might have thought 5 years ago. They were very clever in the last few days. When their price was pushed up, they issued new shares. And so those new shares brought in a lot of money, and that money will allow them to survive longer in a business that may actually have to shut down ultimately. If that's the case, that money will have been wasted. It would have been better spent on new vaccine research than perhaps sustaining a business that's failing. And so that's an example of the economic inefficiencies that concern us when we think about having prices that are informative of the true values of a company. Nobody believes that GameStop had a true fundamental value above $400 or even above $100. It hasn't traded above 30 for about 5 years. And of course, like other retail companies, it's got problems right now. It trades a product that is easily delivered over the internet and can be purchased over the internet as well. And they have bricks and mortar stores. We've seen many other retailers go bankrupt under those circumstances. I have no information that would suggest that they will go bankrupt, but frankly, their prospects don't seem to me to justify a valuation of 100 or 400. So there's no question that there was an extraordinary volatility event here. Okay, so with that said, let me turn to Terry and ask him for any perspectives he might have on the traders who engaged in this trading, and perhaps on how they organized. Terry? Terry, you're on mute.
Thank you. All right. So I actually just wrote a paper about Robinhood users with my perennial co-author Brad Barber, Xing Wang, and Chris Schwartz. A timely choice of topics. And what we were looking at were events where there was a big increase in the number of Robinhood users and what subsequently happened. Now, we looked at, we ranged just how big the event had to be. We had initially looked at 20,000 such events, and then a narrower set of what we called big hurting events. And the big hurting events were where you got a couple hundred-fold increase in the number of users in Robinhood in a day. And the question is, what happens? Well, contemporaneous with the increase in the number of users, you see a big spike in price in most cases, right? The price goes up a lot. And consistently over the next few days, in particular over the next 20 days, it drops back down. It doesn't, on average, drop down as low as where it started. And in some cases, maybe, sometimes the stock may have been underpriced to begin with. But what we see is this buying activity all at once, highly concentrated, and drops of 20% on average for the extreme events over the next few weeks. We also looked to see, the information we had wasn't detailed enough to exactly figure out how much money was made or lost, but we were able to determine at least that more of these users were losing money than making money, just because a lot of the buying came in after the price had pushed up quite a bit. I think of what happened with Robinhood as sort of the same type of event, but more of a sort of like a supernova. The same thing, but just amped up a great deal. And so a question is sort of, well, what coordinates this herding activity, herding in the sense that people, these retail investors are all suddenly on the buy side of the market at the same time. And I think what this is doing is a combination of human psychology and cognitive limitations with changes in technology. On the human psychology thing is, we can only process so much information. We have limited attention. So when an investor decides to buy a stock, it's rare that the investor says, well, I've got 5,000 choices. Let me give some thought to each of them. More often, an investor is just going to wait till the stock catches his or her attention and then say, I like it or I don't like it. So, it used to be, how did that happen? Well, for those of us old enough to remember Louis Rookheiser, you'd say, oh, you watch Wall Street Week on Friday night, and if he talks about a stock you like, you call your broker up on Monday morning and you buy it. And it's been shown that the stocks that recommended on that show went up on Monday and then drifted down over the next few days. Same thing happened in the newspaper, the dartboard column in the Wall Street Journal. Then you get to 24/7 television, and there have been studies that say, the same thing happens when Kramer recommends a stock. And you can even see, I've seen graphs in real time. Kramer gives his pitch, stock price goes up, stock price goes down. And with another paper I'm looking at, we've gone and then looked at the trading of retail investors around these events. It's just what you'd expect. Retail investor buying goes up, stock price goes down. What's interesting with the change of technology is back in the 70s and even the 80s, you couldn't really buy a stock because you knew other individuals were buying it. You might buy it because it caught your attention, it was in the paper, and maybe you're buying for the same reason they're buying. Or you might read it had a lot of volume. But it was very hard, other than your brother-in-law or your next door neighbor, to really know what anyone else was doing. And that has changed. And I think that's a really interesting thing, that you could be on Reddit, on Wall Street Bets, and suddenly you know what other people are thinking, and you know what they're planning to do. And there's both a group think where everyone is giving the same story. Oh, this is going up. There's probably some of the excitement of being in a group activity. Oh, we're all doing this together. And there's this coordination where suddenly you have all these people doing the same thing at the same time. And to some extent, there's a lack of the sort of analysis that Larry was just giving us. There probably weren't a lot of people saying, well, this thing can't possibly be worth what it's trading at today. So anyone who buys it is taking an awfully big risk. So I think that, well, human psychology, and I've spent most of my academic career focusing on how the biases, decision biases, the heuristics, the cognitive limitations we have affect investor behavior. But I think the other part of it is, as the technology and the environment changes, that affects behavior quite a bit too.
Thank you very much, Terry. Pete, you want to talk a little bit about manipulation, how we should think about whether this was okay or not, or should the rules change?
Yeah, be happy to chat about that. And let me start with something you said, Larry, and that is market confidence is very important because it's important that investors feel comfortable investing in equities. One of the reasons that Americans are wealthier on average than Germans, it's not that we save more, it's that we invest in equities and we've earned a higher return investing in equities that, say, people in Germany have earned investing in cash. So it's good to have a society in which people have confidence enough to invest in equities. They get a good return, and also they stimulate economic growth and make the economy function better. If you look at the history of the SEC, where Larry, I should say, was the chief economist a number of years ago, one of the reasons it was set up during the Great Depression was to help restore market confidence. And part of the mission of restoring market confidence is to allow investors to correctly feel that markets are not rigged against them. And so you have a concept of price manipulation, which is essentially a nefarious practice that you don't want other people to follow. So how do you define it? And the interesting thing about price manipulation is that the law doesn't give you a real precise definition in many cases. Price manipulation is just an abusive practice that creates an artificial price. Well, what does that mean? Well, that means we haven't figured out a precise way to define it in terms that are easily verified by objective analysis, but there's an element of subjectivity or an element of economic analysis that needs to be applied to think about what price manipulation is. So if we ask ourselves, is there manipulation going on in the case of GameStop? We open up intellectually and also factually a kind of interesting can of worms. So let me describe first what price manipulation is not, and then I'll describe what I think price manipulation is. So I think what price manipulation is not, it's not differences of opinion. Some people like a company and they buy it. Other people don't like a company and they sell it. And the market you could think of as a kind of averaging mechanism, which puts all the differences of opinion that people have together and comes up with a price. Now, what is it that we want markets to do for us? Well, I wrote a paper on this a number of years ago, and I said there are kind of two things that we would like the market to do for us. The first one Larry mentioned, and that is we would like for the market to create prices that are reasonably good approximations of value. Economists call that efficient markets, but reasonably good approximations of value. And one of the reasons we want markets to do that is so that if a naive investor who doesn't understand what a stock is really worth comes in and buys it just because they like it or they fell in love with it, having reasonable prices protects them from paying too much. The other thing that we would like markets to do is to be reasonably liquid so that we can trade the stocks pretty easily. If you look at what Terry was just saying a minute ago, when stocks are recommended and many people go in and buy the stocks the next day, the price bumps up. Well, it would be good if the price didn't bump up that much. Maybe bumping up a little bit is reasonable, but you don't want it to bump up too much, right? So having a more liquid market and a more accurate price, those are good goals of a market. So let's define price manipulation as an abusive practice, kind of the way the law does. But we're left with the question of what kind of abusive practices might there be that would interfere with the market's ability to create an accurate price and also interfere with the market's ability to make the stock easy to trade. And I would say that they're kind of two. If I were at the SEC, I would be looking at two different angles on manipulation. The first angle I'm going to call a short squeeze, in the sense that you are putting kind of artificial pressure on the people who have sold the stock short. One way you do that is by making it very expensive for them to borrow the shares they need to sell, or to borrow the shares that they need to even kind of roll over from time to time to maintain their short position. And the way you can make that very expensive for them is if you yourself own or control a large amount of the stock and just refuse to lend it to them. Now, what it would look like is that you're turning down a profit opportunity. It's almost like you're turning down the ability to make something out of nothing when you do that. And so it's a kind of big red flag that the SEC could look for to see if someone is not lending shares that could be lending shares and making lives for the short sellers easier. And that would, in general, have a beneficial effect on markets by allowing the short sellers to kind of cast their vote on what they think the price is worth. Okay, the other type of, but I haven't seen a lot of facts on exactly who is lending and who is not lending the shares. So I think it's something that should be investigated, and maybe we'll get some kind of report or something on this. You don't want it to be too hard for short sellers to sell shares short. Otherwise, naive investors are not protected against what I'm going to talk about next. And what I'm going to talk about next is another type of manipulation, where someone circulates rumors or circulates information, or maybe they just circulate lies, saying, I think this is the greatest stock in the world. And they persuade naive investors to buy it, and the naive investors buy it, and that pushes the price up enormously, just like Larry described happened to GameStop. And like Terry was describing, what retail investors are inclined to do. So But what if the person who is circulating that information or circulating the rumors saying that the stock is great and that everybody should buy it is actually selling it behind their backs? There's an element of something that looks like and smells like fraud there, that you're trying to make money at somebody else's expense by using deceit, saying you like the stock when you really don't. So that's another thing that I would look at if I were the SEC and investigate if any of the people who are participating in spreading information about the stock were actually trading in the opposite direction from the way they were participating. And finally, whether you are holding the collateral off the market and not lending it to the shorts, or whether you are trying to keep the price pumped up by circulating bad information, one thing you could look for is whether there's a conspiracy. In other words, whether you're working together with some kind of agreement with other people. Now, I think an agreement among 10,000 retail traders that's not signed, but it's just a kind of herd mentality, that might not pass. I don't know, I'm not a lawyer, but that might not pass legal muster as a conspiracy. But there could be a small group of people who are colluding to not lend collateral to the short sellers. We don't know whether that's the case or not. We haven't seen the facts yet. Or there could be a small group of people who are systematically spreading rumors that they know to be false because they're trading in the opposite direction. That's something that I think should be investigated. So let me summarize. In general, we want the market price to be accurate. We want markets to be liquid. Things can go awry like they've seemed to have gone in GameStop. And when things start going awry, some other things can happen that economists have also studied. And one is that if you're short or if you trade in a margin account, you might be voting with sort of like casting lots of votes in an election or something. You're trying to throw your weight around more than you otherwise would be able to by using leverage to not only sell everything you have, but also go short, or not only to invest all of your money in the stock, but even invest more money than you have by buying on margin. But the downside of that is that if things start moving against you, as Larry said, you get margin calls. And if you get margin calls, you suddenly have less money to invest. And if you have less money to invest, you can only support a smaller position. So the shorts are forced to buy the stock back because the price is moving against them. They have a lot of their wealth invested in the stock. And similarly, a trader who's long, who's got a big long position that's on margin, they will be forced to sell when the price falls because they also get a margin call in the opposite direction. But the result is the price fluctuations get amplified, might not reflect fundamental value. They might rise too much or fall too much. And that's a problem that needs to be thought about. So having reasonable amounts of leverage in the system, not too much and not too little, seems to me to be a worthy goal of securities regulation. So whether there's a repo squeeze going on, that I like to call it, the failure to lend collateral to the shorts, I think that's something Paul Brody will talk to us about later, so I'll stop there.
What a good cue for Paul Brody. Okay. Paul, the most popular question we've seen on the Q&A is, how is it possible that a stock could have short interest of more than 100%? I haven't seen the number myself. I've seen 140 bandied about for GameStop, and that may or may not be so, but I definitely know it's possible. If you could comment on that, but more generally talk about the financing commitments that a broker dealer has to make to support the phenomenal trading that we've seen. And of course, the implications for clearing and settlement and the demands that the National Securities Clearing Corp has on broker dealers. That'll help people understand better what happened with Robinhood and the back office issues.
Mm-hmm. Sure, Larry, thanks. Well, my remarks will probably be a little bit briefer than the professors here, who are undoubtedly accustomed to speaking for about 50 minutes at a time. Let me first start by talking about the financial sector's infrastructure is in place to try to ensure that the system's financially sound. So risk management must be continually enforced at all levels, and the players are brokers and exchanges and clearinghouses and regulators. Capital maintained at several levels provides buffers against a default by any one participant. And the tools for maintaining capital and controls are margin requirements, trading restrictions, capital requirements, and market integrity rules. So despite the negative comments this past week about broker actions, if one understands the plumbing behind the apps and the interfaces, it's not hard to see that the actions taken by brokers and clearinghouses were part of standard risk management, albeit in a roller coaster market. Let me turn to Larry's point about short interests in aggregate. So why is it bad for the markets that we can see such tumultuous, such a roller coaster ride in such a short period of time for a small number of stocks? Let's look at the GameStop numbers. There are about 70 million shares outstanding. I think the float is actually even a little less than that. Market talk was the short interest could have gone as high as 140%. So that would be about 100 million shares over the 70 long. So that implies that there are 170 million shares long, because it's the 70 that are actually issued and outstanding, plus another 100 that went long against those shorts. So if we take, say, Friday's price, pickup price of GameStop, say $350, we're talking about $60 billion. And that's unlikely to be mostly little people. Yes, there are a lot of them, but this is a pretty big number. And what can happen in this case? Well, long holders can repay their margin loans. So margin loans, when somebody buys stock and borrows the money to buy it, frees up that stock. That allows the broker to finance that loan if they wish to by using that stock as collateral. If the customer pays money into their account, repaying that margin loan, the broker can no longer use those shares. So if a lot of that happens, and especially in an environment where brokers are raising margin requirements as prudent risk management strategy, repaying the margin loans means the brokers have to recall the shares that they have lent to other brokers who borrowed them to cover the shorts of their customers, what Larry was talking about before. So if the borrower, the short, is unable, the broker has to buy those shares in the market. And that's going to drive the price up. And at what price? There's no limit to what price a single stock might go to, which is why you can gain 100% if the price goes to zero, but you can literally lose an infinite amount. So imagine the consequences. Let's talk about the plumbing for a little bit. So trades are executed on exchanges. They're submitted to a clearinghouse called National Securities Clearing Corp, NSCC. It's part of what you might have heard called DTCC, which is Depository Trust and Clearing Corp. That's just a holding company. They run a sophisticated risk management system. So that requires clearing member firms to deposit money to cover two components. First is a risk component, because they are protecting the clearinghouse and all of its participants against possible price fluctuations on their obligations between trade date and settlement date, which is 2 days here in the US. They run a value at risk, a VAR type of computation. It's very sophisticated, and it comes up with a risk amount that both sides have to put in. And the second component is a mark-to-market component, which is merely marking the unsettled trades to the current market price, and the broker on the losing side has to pay in that money, which of course comes back when the trades eventually settle in 2 days. So for both computations, all stocks are included, all stocks. These stocks are not singled out. The same computation runs on everything. This VAR charge is very sensitive to spikes in volatility for individual stocks. So one or a small number of individual stocks can really impact the amount of deposit that a clearing member firm has to put up at the clearinghouse. The key being that these deposits protect all of the participants in the process, the brokers in the clearinghouse and the ultimate customers. Because if a default were to cause a broker to go bankrupt, that broker's customers might be at risk, but other brokers and their customers would not be. Because if sufficient deposits had been made at the clearinghouse, they can make everybody good, even though one of the participants might have defaulted. How can excess leverage be controlled? Higher margin requirements is the obvious solution. Brokers did that. They raised margin requirements and put on certain trading restrictions for safety's sake, because brokers recognize quickly, even in real time, that their liabilities, their exposure at the clearinghouse is going up, because especially in a case like this, all of those customers are buying. They're all on the buy side. So a large price movement could create a huge liability for the clearing member firm to have to put up a deposit at the clearinghouse, which is what we read in the news. One simple solution, I'm not promoting this, but the SEC could require short margin of 50%, which is where it starts now, plus, let's say, some variable amount, like 1% for each 1% of short interest reported. In order to facilitate that, by the way, short interest should be reported daily. It's fairly obvious that bringing it out into the sunlight will give everybody more information all the time. Right now, short interest in aggregate for the industry is reported every 2 weeks, and that's on an 8 trading day lag. So it's not actually helpful to anybody. But if you could see it every day for the prior day in aggregate, we're not talking about understanding individual people or firms who own those positions, but rather, what is the general market sense, and is there a short interest building up? That would be very helpful information. So the last thing I want to say is there's a concept of circuit breakers that have been in place for equity index products for years. When markets crashed years and years ago, there was a general recognition that there were futures products and equity products and things that were based around the same thing. And when they all moved in unison, that could create a lot of tumult. And a circuit breaker puts a pause on the trading day. We're human beings. It allows human participants to take a moment to think clearly and then carry on. The futures markets have long had daily price limits in many futures contracts that do exactly that. You hit the price limit, there's a temporary trading halt. So there are various things that the regulators could look at doing to assist risk management and to sort of iron out the bumps a little bit. Let me leave it there and turn it back to you, Larry.
Well, thank you, Paul. Now, I didn't have a stopwatch or anything, but I don't think you spoke any longer than the rest of us, but I don't think you spoke any shorter either, which would suggest that you might qualify as a professor someday. Feifei, can you tell us a bit about institutional investment managers and what you've seen in the last few days and thought about this extraordinary episode?
Yeah, sure, certainly. Thank you, Larry. I just want to, first of all, make it clear to the audience, research affiliates, we are not a hedge fund. We actually take a long-term perspective when we approach investing. And at research affiliates, we offer long-only, fundamental-based, valuation-conscious, well-diversified strategies to investor. Either it's active equity strategy or it's smart beta, which is a quasi-passive, more like an index type of investing. So we represent only, we don't represent the entire spectrum of buy side, only a very small segment of it. I'm happy to talk about the impact for the segment we operate in, then we extend this discussion into the other spectrum of the buy side, the more fancy hedge funds, long short managers. In the long only space, if you are a long only, very boring value investor, to buy low and sell high, when extraordinary event like this happened, it's really lucky for you. You can sit in the chair, pour out a cup of coffee and watch this interesting episode. As a matter of fact, I think Netflix made an announcement yesterday. They are making a movie out of this GameStop trading, right? So everybody can watch, not only the market participants, but your grandparents, your kids, they can all enjoy to see what's going on. And at Research Affiliates, on the active strategy type of thing we manage, we have discretion over the methodology. So we certainly view this as a great profitable opportunity. We had a lengthy discussion regarding exit threshold, at which point you would like to exit from this position, because clearly this stock is, the price has been pushed up too high. We got this stock into our strategy because it was a value stock. We got it years ago when the price was a low single digit. When we look at sales and book value, etc., the economic footprint, the fundamental of the firm actually dwarfs its market capitalization back then. So we bought it as a lowly priced, undervalued stock. And typically, we buy low and sell high because we believe if the company's fundamental or certain anchor is the kind of the central point for the price to fluctuate around, eventually the mean revert process will bring the price, undervalue the securities price higher so we can make a profit. In this case, the price went way up higher than we expected. We were not really up to the rebalancing time yet. So we talked about the exit rule. We look at the historical, sample over past 10 years. Only GameStop is the only stock, when we look at the monthly data, is the only stock whose price has gone up like 20 times within a short period of time, within a quarter. And over the entire investable universe we manage, which is more than 10,000 securities, including US security, international, emerging market, small cap. Again, over past 10 years, when we look at quarterly data, only 3 occasions, the individual stock's price went up, 5 times higher. So that's a very rare event. When that happens, we should certainly capitalize it and make money for our investor. And on the passive side of, investment strategy we manage, we call smart beta, which is a kind of index investing. We don't have lots of flexibility. Rule is a rule. So we stick to the rule. And I watched the GameStop rise to, number 3 in one of the strategy we offer with the index partner FTSE Russell. And now, because of the price drop to around $90, I think today the stock is number 22 in that particular portfolio. I think the rebalancing date hasn't come yet. But even when it came, a month later, if we can sell the stock at $50, it's still pretty awesome game because we got it at really, really low price. And on the other hand, I do want to mention, when you get into an index strategy, you pay very low management fee. That's also the cost. You don't have lots of flexibility. And to a degree, I don't even know whether the flexibility would always be good or bad for you because, in this case, certainly you want to sell it early, but there are other cases you want to change the rule, but ex post, you could know you were wrong. For example, for our, index strategy during global financial crisis in 2009, March, we were supposed to rebalance and we got lots of clients calls telling us to stop rebalancing back into financials because, we have to, increase the weights of financials since their fundamental size really are much larger than the price they were given back then. So we stick to the rule. We basically told the investor, this is the index strategy. We cannot frequently change the rule. So we actually got into a very sizable position of Citibank, of Bank of America. And all those large positions became much larger in the next 6 months and 12 months. which created a pretty awesome alpha for our smart beta investors. So that's the space we operate in. And now, when we take a look into the, hedge fund space, even though we don't operate in the space, I spoke with, my friends out of curiosity. I learned from the people who have more expertise than I do to see how they operate. When we talk about long short strategy, often we refer to fundamental based hedge fund. And those guys actually take very concentrated position. Because I did ask them, how come you guys don't put, a position limit? They said, we have very concentrated position. We typically don't do that. And, when we look at the quantitative method to do risk management, most of the time they don't add value. But that's true. We know risk management over the performance, over the return, they don't add value. They are supposed to reduce risk. So I think, this is a lesson I think those long short people, those hedge funds could actually really, really learn. I think retail investors identified a loophole in their operation. They taught them a lesson. And I think hedge funds need to become much more serious about risk management in terms of, putting enough money aside to meet margin costs, and also position limit. In terms of, retail participation has grown up really, really high from 5 percentage points to, 35% as of today. So the market participation changed. I think the hedge fund managers need to get used to their short position have to lose lots of money before they can make a gain. The duration of them making the money will be much longer than before. And I think that's the reality people have to face. In addition, I think for our investors, for young investors like the audience, we also need to understand shorting can be extremely dangerous, even when you are right. Simply because your timing is imperfect, shorting can be very, very dangerous. So I really want investors, young investors, to form a long-term perspective when we approach investing. But people also enjoy taking pleasure from gambling. So I think just limit your allocation in this type of activity.
Great. Well, thank you very much. So as we've gone around among our various experts, I'm sure that all of them have thought of some things that they might have wanted to add, as I did. I'm going to make three very quick points, and then ask the rest of you if you wanted to add something that somebody else said that resonated with you. The first one is that when short sellers are hurt, as they are in this circumstance, they're going to withdraw from the market. As Fei said, they're going to employ more risk management. And the problem, of course, is that if the shorts withdraw, then we're going to get more volatility. And the problems that Pete spoke about was of people who are investing in stocks at high prices and don't know it, they're going to end up losing. Another point I'd like to bring to your attention, and this is not well understood, but very important, is that when brokers post capital margins with the Clearing Corporation, NSCC, they're not allowed to use their customers' money. They can only use the capital that belongs and is owned by the broker. And the reason for this is that we don't want the brokers to be losing our customers' money. And so while you think that, gee, the customer has all the money to pay for the stock, why are we worried about this? And the answer is that the system has to be secured by the broker's money, not just the customer's money. And then the last thing I would like to bring to everybody's attention is something that has hardly ever appeared in the press in this episode, which is that these hedge funds are not just a monolith called a hedge fund. They are investment vehicles into which people invest money. And the entities that invest in hedge funds include public pension funds, primarily. And those public pension funds are teachers, firemen, policemen, and also the private pension funds, the electricians, the plumbers, and all sorts. And so while the hedge funds have been kicked in the teeth and certain elements may be rejoicing in this tension between the small guy and the big guy, There are an awful lot of small guys who got hurt because they were invested in hedge funds that, while we could criticize the management, the risk management on an ex post basis, perhaps wasn't so unreasonable on an ex ante basis. Remember that we're calling for better risk management, not against fundamental risks, but we're calling for better risk management against collective actions, whether by design or by chance, that have caused prices to move far, far from where they really ought to be. And so blaming hedge funds and saying this is appropriate is problematic. And it represents the people who argue, now the fourth point. I'll make this point later. I don't want to dominate this. Anybody else have any other observations they'd like to add? We can also turn to some questions.
I'd say one thing, sort of taking off of what Feifei was saying, is that I think there's been perhaps a lack of clarity between investing long-term for your environment and having some fun. And people who are investing, like actively trading money that they can easily afford to lose, that's very different than people investing money they can't afford to lose. And I know, even from talking to some reporters today, there are going to be stories about people who lost money that they could not afford to lose in this process. And what's Robinhood's mission statement? To democratize investing for all, or something close to that. They are making it very easy to trade, and that's true. And they're also, to some extent, hiding some of the costs, because the commissions are free, but there are other costs, such as the poor execution due to payment for order flow and things like that. I actually think the democratization, probably somebody got there first when Jack Bogle made it possible to have a well-diversified long-term strategy and pay $4 for every 10,000 you had invested a year. I actually just worry about people who are trading like a game, but with money that they can't afford to lose.
I would like to add just a couple of sentences to what Terry said. And that is, and also to what Pepe said, that is people who do like to trade, especially younger people, they make the mistake of being momentum traders, and they make the mistake of being momentum traders with the wrong time horizon for momentum. So they just get the timing really bad. They'll be seeing a stock that goes up, and they fall in love with it, and they buy it because they like it, and it's a good company. But it's very overvalued, and they buy it when everybody else is buying it, which pushes the price up even more. And then subsequent returns are kind of bad. So if you're not a huge expert, you might be better off being a kind of contrarian trader over fairly long horizons. And Feifei described the advantages of being a contrarian trader, buying a bag of stocks. You can sell them when they become overpriced or highly priced.
Anybody else want to add something?
I'll just say that despite all the negative political overtones these days, to make a point on what Pete said, can you imagine how much worse it would have been for the small investors who ended up losing had the brokers not put the brakes on some of this trading?
Good point. Very good point. We have about 15 minutes left to us, and we have enough questions to occupy us for about 15 days. So we're going to have to be parsimonious in our responses and the questions too. By far and away, the most popular question seems to be, how is it possible that more shares can be sold short than there are shares outstanding? So we'll direct that to Paul, and then also ask him, how does that resolve itself? What challenges are there of reducing that short interest?
Right. So you start with the float that's out there, and let's use the numbers we were talking about, GameStop. Let's just say it's 70 million shares. And then somebody comes in to sell short. So that short seller is going to borrow shares from one of those holders of the long stock. Well, after that transaction takes place, you now have one more party that's long and one more, and to offset that one party who's short. So you have what I like to think of as open interest, long and short, above the actual shares outstanding. But those shares cycled around. Now, the next time that happens, somebody else sells short, they also borrow shares. But they may be borrowing shares that the first short seller sold to and delivered to. And that is a mechanism where the shares that would seem to be outstanding spiral upward because the pump has been primed by could even be a small number of shares, because if you do a lot of these transactions around and around, whoever's long at the end of the day can lend those shares to the next short who comes in. And that's how you get a situation where you can have huge short interest that could even exceed the long outstanding issued shares. How does it unwind? The easy answer is the transactions start going in the other direction, where the shorts buy themselves in, and when they get delivery, then they return the borrowed shares. And that's true. In practice, there's a stickiness to that for some reason. It's operational, I think, because the shares among brokers, the brokers gotta lend the shares. Now they have to get them back. Maybe there's a delay time because there are rules that you can't demand shares back right away. You have to give the settlement period of 2 or 3 days to get shares back. There's a stickiness to unwinding that spiral that just throws another wrench into the works here. But that's how you can get tremendous short interest.
Great. And I'll put this next question to Pete. Somebody asked, why would a hedge fund short a stock instead of buying put options? And the questioner says, there seems to be a lot more risk when doing so, yet relatively little extra upside. And so
Yeah, that is a very good question, and you get it. I've gotten that question many times before. And the answer, there are several reasons why you'd rather short the stock. First of all, trading the stock is probably more liquid than trading the options. So the cost of doing the trade is going to be lower if you sell the stock short than if you sell the option or buy the option. Second of all, the returns on buying options might be rather low. So and that's because the volatility that is factored into the option price might be higher than what the subsequent volatility of the stock is actually going to be. And so you wind up paying a lot for the option price. And then the third factor is if you wanted to sell the stock short, you would have to, of course, borrow it. And you would have to pay a fee to borrow it. That's a cost. You might think, why don't I just buy a put option? I don't have to pay the fee. Well, guess what? That fee is going to be priced into the put option because there's somebody who's doing arbitrage between the option and the stock that's going to price that fee into the option. So there are 3 reasons why trading options are expensive. They're not as liquid as the stock. The fees for shorting them are already built into the price, and the volatility that is used to price them might be too high. And those 3 things all make the price of buying a put option expensive.
and of course, if the
Sorry.
exclusive,
Yeah, good.
sure, go ahead.
So I thought about that a lot as well. I agree with everything Pete said, but there was one additional reason I thought about, but I wasn't sure whether it's a true reason. I'd like to get Pete's opinion on that. I thought when you buy put option, you also associate a very explicit time horizon with it. So you really predict the stock price go down below certain level within certain days, because the option time decay is pretty fast. But when you do shorts, you can, choose a roughly target, hopefully the GME price go down to $20 within, 3 months or 6 months. I don't have to be very accurate with my time estimate. Would that actually play a role as well?
It certainly does play a role, whether you're buying a put option or a call option. If the horizon, you're waiting for the price of the stock to fall when you buy a put option, you're waiting for it to rise when you buy a call option. It's not going to fall for 5 years. You probably have a hard time finding options with a 5-year maturity that you could even trade. And the ones that are more liquid, they have a higher cost than trading the stock, but they're more liquid than the ones with sometimes with the longer maturities. They may not have a maturity long enough for your idea to work. So it's a good point.
I'd like to emphasize that if we had a world where hedge funds simply were prohibited from going short but could still buy puts, then their buying puts, as Pete said, would just transfer the problem from the hedge fund to the dealers who sell the puts, because the dealers will hedge by going short. Here's another question. Perhaps Terry want to pick this one up, and maybe already expressed a little bit, but getting a chance to riff a little bit more. What are your feelings about the Reddit thread Wall Street Bets and the groupthink theories that quickly arose, which influenced retail traders to buy in late in the game?
Well, this is the problem, isn't it? It's the people who arrive late to the party. And as somebody mentioned before, while it's not explicitly the same, the dynamics are a little different than a Ponzi scheme. When the prices get so far above fundamentals that the only thing keeping them there is new buyers, it has that same feature that when you run out of new buyers, it's going to all come crashing down, and the last people to come in get hurt. It worries me. I mean, yeah, I'm not worried about the overall, so much the functionality of the market as people who, as I say, some people are betting money they can't afford to lose, and they don't really understand. It's just exciting. And then you get on a site where there's this sort of groupthink. Everyone says this is what's going to happen, and you join in. Probably better to do it with $5 than 50,000. You can get a little bit of the thrill with a lot less risk.
Can I add a little thought here?
Please.
Back during the dot-com bubble, in the late 1990s, there were people that put their entire retirement nest egg into dot-com stocks, thinking that they were going to be able to retire at the age of 60 rather than the age of 65. And there were hedge funds just shorting the dot-com stocks, but they got run over and had to buy in their positions and push the price up even higher. And some of these people who, friends of mine, bought at these peak prices back in 1999. And guess what? They didn't retire at 60, and they didn't retire at 65 either. They're still working. And that is the situation you don't want to see that happens when markets get disconnected from fundamentals for years at a time. You wonder whether that's going on now or not. But back in the dot-com bubble, they called it the new economy. It turned out it wasn't all that new after all. What's going on in markets today has a similar flavor.
So we've only 5 more minutes before us. I'd like to introduce the last topic. It's a little bit of a softer topic, but still extraordinarily interesting, which is the question of sort of economic justice. The Wall Street Bets people have promoted themes that, hey, this is just the common guy getting back at the big guys. The big guys have been running us over, doing all sorts of illegal things, and so this is just economic justice. My observation about this, and I'll ask our other panelists for their observations as well. The first observation is that this is a moral equivalence argument. It says that you did bad, so I can do bad as well. And you've heard many, many times probably from when you were 4 years old that two wrongs don't make a right. So I find that a particularly troubling argument. Although, of course, they don't think that they're in the wrong, but their trading is, if not illegal, certainly disruptive. It's not making the markets more liquid, and it's not making prices more informative. And as a consequence, you can only conclude that their trading is parasitic, which I find troubling. But this question of, democracy and stuff like that, and, the SEC looks out for the big guys and not the small guys. I wonder if you could our panelists could comment on that and what your impressions are about the movement as a whole. Anybody want to take a
I'll
piece at this?
comment just in 2 sentences. There has been an increased participation by retail investors in the market recently, but retail investors often tend to be momentum traders. And institutional investors are a smaller fraction of the market, and they often tend to be contrarian. For example, value trading tends to be contrarian. And that increased mix of retail investors probably will enhance volatility, at least for a while. And that will perhaps lead to low returns after prices have been running up. It's something we need to worry about. I don't know what you can do besides issue warnings and educate people like we're trying to do today, and tell people to be careful and pursue prudent personal risk management. But that's something to think about.
Paul, let me ask you, is it your impression that the SEC has failed to enforce against large institutions, that they have a bias towards going after small people?
Not been my impression. I think they do just fine going after the large guys. They spend a lot of resources there, and they probably get better return there. They don't have much, they don't have much reason to go after the little guys.
Right. Okay. We are approaching the end of our time. And so I want to thank all of our panelists and ask if there's any last words that somebody'd like to throw in. Okay, well, lacking such words, let me turn it over again to our USC hostess, and thank everybody for your attention, and remind you that great things are happening at USC, and we greatly appreciate all your support and, of course, your concern about these events that are happening in our markets. Thank you so much for attending, and now we'll hear just a few final words.
Yes, thank you to everyone for joining this webinar today. And thank you once again to all of our panelists here. As mentioned, this webinar has been recorded and we'll be sending a follow-up email to all of our registrants later this week. So thank you again, and I will end the webinar now. Bye, everyone. Thank you.
Bye-bye. Thank you.